Welcome back. The return of the trading desk. According to the Wall Street Journal, U.S. banks are having their best year for trading revenue since the financial crisis because of the rise in volatility. Joining us this morning is Thomas H. Lee Partners Co-President Scott Sperling. Scott, good to see you. Thanks so much for joining us.
Thank you, Maria. Good to see you.
Where do you see the growth right now? Tell us about your investing and how you're allocating capital, Scott.
So I think the areas that people have been looking at are ones where there are stronger secular growth trends. And the entire healthcare sector is one where that continues to be an interesting opportunity, particularly in areas where you can help bend the cost curve, be able to provide high-quality services with a more cost-efficient delivery mechanism. Another area is obviously the entire technology world offers significant subsectors of opportunity. The software area has been one that has been incredibly popular. One of the things that we always have to do is measure the secular growth against the pricing it takes to buy those kinds of companies. And I think having a reasonable amount of discipline in today's world will be rewarded long term.
Are you seeing that both on the public side and on the private side? We started the conversation talking about the return of the trading desk because of an increase in volatility. Sure. Do you see that those growth areas both on public side as well as private side, which is what you're doing, obviously, private investing?
Yes, I think on the growth, these areas are ones that will account for a bigger and bigger percentage of the economic activity in the country, regardless of whether it's you're looking at companies that are still private or on the public side. So I think these are areas that will be interesting in both the public markets as well as the private markets. The ability of investors in today's public market to buy these companies at multiples that look something like 16 to 17 times, down from probably 19 to 20 times, could be reasonably attractive. The fundamentals that we see in the economy right now continue to be relatively strong. I think it's not unreasonable to expect 3% GDP growth. I think when you combine that with the stimulus, and some of that's coming from the stimulus of the tax cut, but combine it with the longer-term impact of the stimulus of the tax cut, you can see this playing out for a longer duration than we ever would have thought when you look at the tenor of this recovery period.
Question, James Freeman here with the Wall Street Journal. Question on interest rates.
Yes.
Some people get a little nervous when the yield on the 10-year Treasury note hits 3%. As you know, we've had a lot of good years with that level, good years for the economy, for the stock market. But I'm wondering what it means for you and your ability to do deals. Where do you get nervous in terms of that interest rates going up or that number on the 10-year going up?
Sure. That is clearly part of the equation that we look at. We want to be in a world where the coverage ratios of our obligations is reasonably high. We never returned to that 06 to 07 period when the coverage ratios had gotten well below 1.5x, 1.5 times. So as you look at the cost of debt, that comes into the calculation of what we're willing to pay for companies. 3%, as you point out, is actually a relatively attractive rate when you look long-term at where those rates have been. Oftentimes, in our history, it's been closer to 5%, but certainly it's much higher than it's probably 100 basis points higher than we had gotten used to over the last few years. So it certainly has some impact on the value that we're willing to pay for companies.
Scott, what's your take on technology here? I mean, smart speaker maker Sonos is reportedly going public. The Journal first reporting that the IPO could value the company as high as $3 billion. Your thoughts on the IPO landscape and where you see technology opportunities today?
So the markets will fall in and out of love, obviously, with any kind of company, and certainly the technology sector has benefited when you look at the so-called FANG stocks and the impact that has had in terms of the growth of the equity market values. It's been reasonably overwhelming. So technology, because it does have significant secular growth in an economy where growth has been hard, has been very popular. I think the applicability of technology to everything we do in our lives. So Sonos, for example, has certainly made it easier to have audio that has a diverse number of sources available to people in their homes. that kind of technology is one that will scale very well in the consumer market, and people will pay for that. Now, what you have to look at is what the nature of the competition will be over time, and while the overall market for that type of product, that functionality, will continue to grow very strongly, and everyone will evaluate the specific competitors within that to see, what kind of share that they will have. Sonos clearly has benefited from being one of the early drivers of this trend and this technology, and you see that, I think, in the expected value I think they want for the IPO.
We were talking about Wall Street trading desk doing so well, and also about Deutsche Bank not doing well. There are a lot of these big U.S. banks that keep complaining that if regulators here demand they hold too much capital, it'll be a big disadvantage versus their overseas competitors, and yet the U.S. banks seem to be crushing it versus their international competition. Yeah,
they sure do. I think you have, you have smart people across the industry. I can't comment on Deutsche Bank. The people we deal with are on the investment banking side and have been very good. I can't comment more broadly on DB. But the banks have adapted very well to the new rules that have dramatically reduced the leverage ratios at our commercial banking system. So whereas in 06, 07, you were looking at 20 to 30 times leverage, today you're really looking at 10 to 12 times leverage. So the ROE, the return on their equity, is not going to be as good as it was then, but they've adapted very well to that. You see Goldman, for example, Lloyd Blankfein has been out there talking about the consumer opportunity that Goldman has, and Marcus has been a major effort for them to provide a set of services to the consumer market. So they are looking at new areas of growth, and at the same time, they continue to have very, very smart people who are very helpful to people like us who are looking to them for financing and M&A advice.
Yeah, it's interesting. Goldman's trying to is into the retail market. Blackstone Group into the retail market. Scott, it's good to see you, sir. Thanks so much. Scott Sperling.
You're very welcome.
Joining us this morning, and to you.